On April 24, 2026, U.S. equities are trading in an increasingly narrow AI-led structure, with month-end pension rebalancing acting as a near-term technical pressure point. While the S&P 500 rose 0.8% to a record close, and the Nasdaq rallied 1.6%, the underlying market breadth is narrowing. Investors are prioritizing AI-linked winners, while the Dow slipped, signaling that the surface-level message of strength may be masking shifting technical flows.
The market's concentration is no longer a side note, it is the central story. AI-linked stocks are estimated to account for roughly 45% of the S&P 500's total market value. This means the largest platform and chip companies are carrying an outsized portion of the index. While this concentration keeps the headline performance looking robust, it masks a lack of true diversification. If those few AI leaders hold their ground, the index appears healthy. However, if they falter, passive investors are exposed to the immediate impact. Intel's 23.6% jump marked its strongest single-day performance since 1987. While first-quarter revenue of $13.6 billion and non-GAAP earnings of 29 cents represent genuine progress, the sheer scale of the move highlights broader market behavior. Investors are aggressively pricing in AI infrastructure potential, even while the fundamental turnaround remains in its early chapters. Month-end rebalancing is creating a mechanical headwind. As stock prices rally, many pension funds that target fixed portfolio weights find themselves overweight in equities. To rebalance, they are often forced to trim their stock positions and buy bonds. While this does not automatically end a rally, it does mean the market has to absorb more supply. In an environment where a small group of leaders is driving the indices, that technical selling can weigh more heavily on the very stocks carrying the most momentum. Next week's mega-cap earnings will show if this narrow market leadership holds up. Amazon reports on April 29th, and the bar for AWS is high, after it grew 24% in the fourth quarter and 20% for full year 2025. Investors are looking for proof that AWS can maintain that growth while keeping margins and AI-related spending in check. Cloud strength remains the clearest way for the market to justify its current AI-heavy positioning. Alphabet provides the spending side of this infrastructure test. Guidance for 2026 suggests capital expenditures between $175 and $185 billion, a massive commitment to AI scaling. The question now isn't whether the company can afford to spend, but whether its core businesses, search, cloud, and YouTube, can efficiently convert that massive investment into the revenue and margin growth required to sustain investor confidence. CapEx is no longer just back-office plumbing. It is the central earnings story. Texas Instruments adds a useful check outside the mega-cap platform names. TI reported first-quarter revenue of $4.83 billion, up 19% from a year ago, and guided second-quarter revenue to $5.0 billion to $5.4 billion. Growth led by industrial and data center demand gives the AI cycle a broader hardware read-through. The infrastructure build is not only a software story. Real chips, power, and manufacturing capacity still matter. AI infrastructure is not automatically shareholder-friendly. IREN is targeting a 140,000 GPU expansion and $3.4 billion in annualized revenue by the end of 2026, but that target depends entirely on deployment, utilization, pricing, and financing. That is the core trade-off across the AI build-out. The potential upside can look huge, but the capital required to get there is just as large. In this environment, execution matters far more than simple theme exposure. Apple is approaching a major test of its AI strategy. On September 1, 2026, John Ternus takes over as CEO, with Tim Cook moving to executive chairman. This transition installs a hardware-focused leader at a time when investors are intensely focused on Apple's AI output. While the company's ecosystem remains strong, the market's core question is whether this next leadership chapter can translate that existing base into a distinct, high-impact AI product cycle. Beneath the surface of today's tech rally, a persistent macro risk remains. The ongoing closure of the Strait of Hormuz continues to disrupt global energy markets, while U.S. pressure on Iranian oil flows adds further complexity. While these pressures were not the primary driver for today's equity gains, they represent tangible risks. Rerouted shipping and higher energy costs can eventually filter through to affect corporate margins and broader supply chains.
Crypto is echoing the same narrowness we see in stocks. Bitcoin dominance has moved back above 60%, even as many altcoins continue to lag. While the two markets don't map perfectly, the rhyme is clear. Capital is concentrating in the assets investors trust most. Across both crypto and stocks, broad risk appetite isn't spreading evenly. It's clustering around the perceived safest winners.
To wrap up, keep an eye on these three signals. First, watch for broader market participation. The S&P 500 needs more than just AI megacaps and semis to prove its strength. Second, focus on next week's tech earnings, specifically whether cloud growth and margin discipline justify Alphabet and Amazon's massive capital spending. Finally, track whether month-end rebalancing creates simple market noise, or if it highlights an unhealthy reliance on a small group of crowded winners. April 24 marked a strong day for markets, but it is not a broad all-clear. While the S&P 500 reached a record high, and Intel helped boost semiconductor sentiment, the rally is doing more work with fewer stocks. We are looking at a clear fork in the road. If upcoming earnings confirm the AI spending story, the tape can keep grinding higher. If they fall short, that concentration flips from a source of support into a point of vulnerability.